Are you watching gold? The price of gold as of the recording of this video is $4,340 an ounce. After a phenomenal run in 2025 where the yellow metal hit multiple all-time highs and price surges of up to 60%, the question isn't if gold is valuable, it's where does it go from here? Deutsche Bank sees $5,000 an ounce by end of 2026. Others predict a pullback. Before you put a dollar into bullion in 2026, you need to watch this video. We are breaking down the 5 most important things that are shaping the gold market right now. Number 1 is the central bank gold rush and geopolitics. The first and biggest driver is the structural shift happening in global finance, central bank demand. It's not just retail investors buying, it's entire nations. For the past few years, central banks in emerging markets such as China, India, and Turkey have been buying gold at a historic pace. Why? Geopolitical de-dollarization. Following the freezing of Russian foreign assets by the West, many countries are looking to reduce their reliance on the US dollar. Gold is the ultimate reserve asset, with no single country's liability. The World Gold Council expects this trend to continue strongly into 2026. What to watch? Any news about trade deals, or the escalation or de-escalation of existing conflicts, such as the Israel-Hamas conflict, or the US-China trade tensions, directly impacts this flight to safety demand from central banks. Number 2 is US monetary policy and the dollar's future. Point number 2 is classic gold investing, US Federal Reserve policy, and the dollar's strength. Gold is priced in US dollars, so when the dollar weakens, it takes more dollars to buy an ounce of gold, pushing the price up. Heading into 2026, the smart consensus is that the US Fed will continue a series of rate cuts, especially if economic growth slows down as predicted by analysts. Why this matters? Lower interest rates make non-yielding assets like gold more attractive compared to assets like treasury bonds. Furthermore, unexpected slowdown in the US economy, possibly into a recession, will make demand for the US dollar less attractive as investors seek less volatile safe havens. The risk to watch. The World Gold Council also highlights a bearish scenario, a reflation return, where strong policy-driven growth, perhaps from new US government policies, causes inflation to spike and forces the Fed to halt cuts or even hike rates. That would strengthen the US dollar and possibly cause a 5 to 20% correction in gold prices. Number 3 is inflation versus stagflation hedge. Gold's traditional role is as an inflation hedge. This point is about distinguishing between inflation and a much trickier scenario, stagflation. Inflation, while cooling, has remained stubbornly elevated above target levels. Gold tends to do well here because it protects your purchasing power. But what if we enter stagflation, high inflation coupled with slow economic growth? JP Morgan research suggests gold is one of the most optimal hedges for this unique combination of risks facing markets in 2026. The key is real yields. Real yield is the bond yield minus the inflation rate. When inflation is high and rates are low or lower, the real yield is often negative. Gold thrives in a negative real yield environment because you're not losing as much money when you're holding on to a non-yielding asset. Number 4, how to buy gold. So you're convinced. So how do you actually invest? Number 1 option is physical gold. Bullions, coins, bars, great for long-term true wealth preservation and a hedge against financial system failure. The catch, you have to have storage, insurance, and high liquidity. You also pay a premium over the spot price. Number 2 option is gold exchange traded funds or ETFs like GLD or IAU. These are the best options for most investors. You remain liquid, you can track the gold price almost perfectly, and you don't worry about storage. Current event note, gold ETF inflows have sharply gained momentum recently, showing renewed institutional interest after a long period of quiet, which is a bullish sign. Number 3 is gold mining stocks. Companies like Barrick Gold or Newmont. These are not gold itself. You are buying a business. They offer potential for greater returns if they cut costs or if they find new deposits. But they also carry operational, regulatory, and management risks. Pro tip: experts suggest keeping your precious metals allocation to a modest 5% to 10% of your total overall portfolio for diversification. Finally, at number 5, here are the 2 biggest risks you must know. Gold is not a guaranteed win. You need to know these 2 biggest downside risks for 2026. Risk number 1, demand destruction in key markets. Record high gold prices are already curbing consumer demand, especially in the jewelry market, which accounts for 40% of global gold consumption. We see jewelry demand fall year on year, even in 2025. If high prices persist, opportunistic buyers in huge markets like India will sell old jewelry instead of buying new ones, putting supply pressure on the price. Even in top consumer China, dealers are offering gold between a discount of $4 and a premium of $1 per ounce above international rates. Risk number 2 is central banks changing course. The biggest driver could become the biggest risk. While unlikely, any major central bank, especially one with excessive holdings, deciding to sell off a portion of its reserves would send a shockwave through the market. We have seen discussions in countries like the Philippines selling off excessive gold holdings. Gold ideally should make up only 8 to 12% of a central bank's gross international reserves. Anything in excess of that should trigger the central bank's monetary board to cash in and capitalize on its gains. This is a very low probability but a high impact event. The consensus is clear. The road to $4,500 and potentially $5,000 an ounce is paved by geopolitical fear and financial uncertainty. The gold bull market is structural, not cyclical, but you still need discipline. Don't chase the rally. Experts suggest adopting a buy on dips strategy and keeping your exposure to a diversified 5 to 10% of your total portfolio. Gold is for wealth preservation, not for getting rich quick. So what do you think? What is your price target for gold in 2026? Let me know in the comments below. Also, subscribe to this channel and hit that notification bell so you don't miss our next deep dive into 2026's hottest investments. Thank you for watching, and I'll see you on the next video.